Today I want to talk about what in the world depreciation actually is. Welcome back, guys. Welcome to Landlord CFO Lionshare Bookkeeping. My name is Ben Day, and we like to help real estate investors figure out their accounting, finance, back office, and automation. And today I want to talk a little bit about depreciation because at the end of the day, it is probably the number 2 buzzword in real estate investing, right behind the number 1, which is cash flow. Everybody's really excited about depreciation. There's a bunch of benefits here. However, pretty consistently, every time we start a new relationship with a client, somewhere around the 3rd or 4th meeting, they actually stop us and they say, "Hey, Ben, I feel kind of like a fool, but could you go ahead and tell me what depreciation is actually?" And so instead of having that conversation over and over again, what we wanted to do is, and really instead of having it one at a time with people, is let's dive into what this actually means and how you can actually begin to use depreciation the best that you can in your business to really scale everything up. Now, when we think about depreciation, there's kind of 2 sides to this coin. There's the actual depreciation expense, and then there's accumulating depreciation. So let's say that I go buy a house for $100,000. I'm going to begin to get depreciation on that house for the purchase price of the building, right? So if I bought the house for 100 and the land was worth 30 and the building is worth 70, and those numbers are way off, but follow it with me here, right? That means that $70,000 for the building is like what I can depreciate effectively. And so from there, I need to figure out, okay, how much of this building am I effectively using up in wear and tear of that purchase price every year? What's the useful life of that property? And then I can begin to say, hey, I'm accumulating depreciation on this property of about, whatever it is, like $16,000 a year, what have you. And so I'm going to accumulate a little bit of depreciation on that property and claim that accumulated depreciation as an expense. And so while the cost basis, the value of my house goes down, my expenses go up in depreciation. It's super cool, lots of fancy tax planning, but there's a lot going into that equation. And what's important to understand is that at the end of the day, you did just spend $100,000 on a house. And if we were treating that cost like a tax deductible expense, then every house that you bought, you could just say, hey, I made $100,000 this year and I bought a $100,000 property, so I don't owe any taxes. And that really spooked the IRS. That was not something that they wanted to see happen because, first, I fundamentally believe that would just make land value explode. Things would be so expensive. But also, that's a really quick and accessible way to not pay any taxes ever. And that's just, at the end of the day, not what we want to begin to do. We want to begin to incentivize housing. We want to begin to incentivize creating housing opportunities without really locking it into an upper class situation. And so what they decided to do, instead of letting you claim everything as an expense, is they said, okay, well, we don't want you to claim it as an expense 100%, at least not in the first year. But how can we make sure that you can still get that as an expenses back just over a much longer period of time? And so there's a room somewhere filled with actuaries, which is just math nerds. And so a bunch of actuaries got together and they decided, okay, what's the useful life of a house? How long do we think that $100,000 purchase of that house will be useful to someone? And they decided at some point somehow that the useful life of that house would be 27 and a half years. So you can take depreciation on that $70,000 of the house, of the actual building. You can depreciate that over 27 and a half years and claim a little bit of that cost every year over time. Instead of claiming it all up front or not getting to claim it at all, we get a little bit over time just as a kind of a thank you for investing and to kind of encourage you to continue to do so. That is, in a nutshell, how depreciation started. Now, and I've kind of touched on this a little bit, it's important to really understand that there are three big things at play when we think about depreciation and why it's so awesome. Number one, it truly is just a paper loss. And what we mean by that is that, like, you can't, like, you didn't spend $3,000 a year on that property. You spent, the 70,000, the 100,000. And so the cash that you're getting back is something that just kind of magically happens with math on the back of a tax return and shows up later over time. And this is a really cool incentive. What that means then is that even if you spend $100,000 this year, you're going to get that benefit for a long time. And so if you're not making a whole bunch of money this year, but you get a big windfall, you invest in that property, and then you're making more and more money over time, you're still having your income brought down progressively. This is really powerful long term as a tax incentive, depending on your income situation. And if it's not really powerful for you right now, it might be really powerful for you in 10 years. And this is a 27-year game on depreciation. So we really like making this happen over the course of your whole life in your investment business, right? And so really powerful incentive for you to begin to bring down your taxable income. And what that also means as an incentive is that, especially on a single family home, if you've got, depreciation of $1,000, $2,000, $3,000 on a single family home, but your free cash flow per door is like $100 a door, $200 a door, your depreciation effectively can wipe out the income that you would have to pay taxes on. If you know that you're going to make $100 a door after expenses on a rental property, that's $1,200 a year. If you're making $1,200 a year in depreciation, that $1,200 in cash flow that you got is now tax free effectively. We love that. That is super cool for a lot of real estate businesses. So you can end up with a little bit of cash flow per door and depreciation. And if you have more depreciation than you have cash flow, you can begin to carry that forward and around into other parts of your income. It becomes super cool, super like nuanced, but the incentives there are really, really powerful. The other thing that depreciation is also very powerful for is the fact that because it's a paper loss and because we're accumulating depreciation on the balance sheet so that we can then claim it as an expense on our income statement, the fact that it's a paper loss like this means that any losses that you're experiencing because of depreciation, there are lenders all over the country that will not consider your portfolio is losing money if the only reason it's losing money is because of the depreciation. They will actually add that depreciation back into your income so they can determine what your NOI actually was on the property. And they can decide if you're running the property effectively, if they can give you more money, if you qualify for a better rate or a bigger loan or what have you. And that becomes really powerful. That's something that we need to not forget. And you should actually strategize your business around making it crystal clear to remove that depreciation and those extra items from the equation when necessary for your lender so that they can begin to quickly give you feedback on what you need to do in your business in order to qualify for bigger and badder loans in the future. Look, y'all, at the end of the day, there's a lot of stuff that you need to know about accounting and finance in a real estate business, along with how to automate all of this stuff so that you don't have to chase all of these details all day. What we've done is we've put together a free class, which you can find down below, that outlines everything here about this and how to become your own CFO through the Landlord CFO system. Now, the third thing that is particularly powerful about depreciation is more advanced tax strategies. This would be stuff like a 1031 exchange or cost segregation, or even fundamentally just your initial rehab on a property. Whatever it is that you have going on, the tax law changes all the time. We're in the beginning of 2021 right now. We think maybe the tax law will change again in regards to this in the future. But generally speaking, depreciation gives us a really powerful avenue. We've already talked about the incentives up front of just on the tax benefits. And we talked about how it's easy for lenders to back depreciation in and out of their equation when trying to decide how much money they're going to give you. But because depreciation exists and it has all of this extra stuff like bonus depreciation and cost segregation and all of these different advanced tools, we're able to use the fact that you can back depreciation in and out of your lending requirement to claim a lot more depreciation up front that again, like doesn't stunt your growth in any way, but does give you massive tax advantages. This is something that is fundamentally underused in real estate investing. And so if you really want to begin to leverage this more often, you need to really look into what is cost segregation, what is a 1031 exchange, what is section 179 in the IRS code if you're not big and bad enough for a cost seg yet. All of these things are ripe for the taking in a real estate business when it comes to planning your taxes. You just have to know that they exist and how to ask the right questions in order to take advantage of them. So let me know in the comments section below what you found the most valuable about this. What do you want to learn more about? And I will see you in the next video.